Welcome back in to ClearPath Retirement Radio. I'm your host, Stewart Smith, and I've got Mitch Davies here. And guess what, guys? It's time for Mitch's Market Minute. Glad to have him back this week. Let us know what your thoughts are, Mitch.
Excited to be back, Stewart. As always, we can get back to the Market Minute, and we've got a ton of fun stuff to talk about. So, as always, we're going to stick to our same structure of first talking about where the markets are at today, this week, what's going on overall. Second, what's been going on for the year, what developments we're watching, and then third, what we're looking forward to in the future. What do we have our eyes on for the next week, the next month, what sectors? So to start things off, the S&P, we got up to 7,000 about a month ago. We're back down to around 6,700 or so. So a little bit down, about 300 points down from all-time highs, there's a ton going on. We've got the Middle East stuff going on. There's a lot happening right now. Oil's up. We'll talk about that. With the NASDAQ is same deal, about the same percentage down from all-time highs, about 300 points. And what we're watching is, we introduced this a couple weeks ago, and the volatility index, which is we call the VIX, where it's right at about 23. And to reiterate with that, we want in a healthy market, the volatility index will sit around 11 to 14. The lower the better, right? So 1 on the VIX would mean that there's no volatility expected in the market. That would mean that markets are just expected to move exactly in a consistent manner, which, is always up and to the right, like we like to say. It's always going up and going to the right. And the higher the VIX, the more volatility that's expected. We see this spike when we have, geopolitical events, when we have election cycles, when we have any major developments coming up. And it's been elevated, above this 20 range for a few weeks now since this Middle Eastern conflict started. And so we're watching this, spiked up to 23, 24 this morning. We've still got some reports coming out of, the Middle East about different strikes and different oil fields and storage facilities and energy facilities getting hit. There's a lot of tension over there, and we're waiting for this to play out. And as this is playing out, we're seeing this spike in the VIX. What we also saw this morning was the PPI data come out. So we have the CPI, which is more commonly known. This is what you would refer to as inflation. This is the number that you hear when people say, oh, inflation's this percent this month or this year. This is the producer side of it. So we've talked about it before. This is the producer price index. So how much are the producers, the manufacturers, the developers seeing inflation in their end before it's passed on to the consumer? And these numbers were higher today as well. So what that means is we have an FOMC meeting today, the Federal Open Market Committee. This is Jerome Powell. This is the people who determine the interest rates. And we were expecting a couple rate cuts this year, but as this inflation stays high, and as oil is trading for almost $100 a barrel right now, we're expecting a very reserved outlook from the Fed today. We're expecting them to come out and say, hey, we're going to hold steady. And current administration is really pushing for lower rates. We're seeing the housing market sort of stall out. We're not seeing as many new homes be sold. We're not seeing as many current listings be sold. So we're in a weird spot where the country needs lower rates. We need to lower these rates to, increase loans, increase new home acquisitions, a lot of things. But when inflation and oil and volatility is high, it's hard for them to justify doing that. So it creates a tough spot, and you will again hear this term stagflation get thrown around, where there's not much, where inflation is going up and there's not much economic growth. So a lot of stuff we're watching here. GDP, we're waiting on the report today. We had advanced estimates are showing a lower number. We want to see at least 2 to 3% growth. We're seeing a much lower number than that, and you want to see that growth continue to grow every year, and we're not seeing that. So we're going to watch that. We're watching oil. We're watching this volatility index. And with all of this stuff going on, guys, the main point I wanted to hammer home is if you're in retirement, if you're getting near retirement, and you're trying to keep up with all this stuff, because like we always talk about, in the accumulation years, when you're still working and you're contributing and you're earning money and you're growing your accounts, it's not as important. Right? Obviously, it's going to affect the accounts, and if your 401k is going to up and down and all that. But when you're getting ready to retire, it becomes much more critical to understand this stuff. And if you're trying to do all this on your own and trying to follow all these different economic timelines and landscapes, it's really challenging. And it's very important to have a firm of professionals who, we live, eat, breathe, and sleep this stuff. We're studying this stuff every day, week in and week out. We've got teams with hundreds of people that are constantly on top of this and managing portfolios in a way that are going to react to this stuff, because every day, every night, these conditions are changing, especially when this volatility index is high. So I would just challenge you, if you're trying to manage all this stuff on your own and you're not fully understanding why things are moving the way they are, give us a call. Come check out ClearPathRetirement.com. This is what we do, and we give clients a peace of mind that, we do a bi-weekly market update where we're, talking about this stuff. But the message is always the same, is that clients don't have to worry about this stuff as much because we're on top of it. And the response I always get from clients is, hey, thanks for the info. It's always good to understand what's going on, but we know you guys got it, right? We don't have to check up on it as much. So if you guys have never, sat down with a firm that can really do that stuff, I'd give us a call.
Absolutely. All right. Well, thanks for that update, Mitch. And that leads right into some things that I want to talk about here. In that, what Mitch was talking about is very important to understand, in that the portfolios that we offer clients at ClearPath are designed portfolios for people in retirement. And investing in retirement, we've said it many, many times, investing in retirement is a different ball game than investing when you're in your accumulation years and you're growing assets. In your accumulation years, you are enjoying contributions to those accounts. You're enjoying matches from the employer to those accounts. You have a long time horizon. You don't really have to watch those accounts very closely. And over good long periods of time, statistically speaking, the market has always done well and given good returns, so that you have that benefit going on. But when you get to retirement, now there's no more contributions, there's no more employer match. The only thing you have is either growth or decline in those accounts, and now you're depending on those accounts for income. And when you take a hit in those accounts and you are also having to pull income off of it with the account down, that is a pretty awful feeling, and our clients have expressed to us many times that is where they felt like, they were making bad decisions. They were, really, watching the markets, anxious, nervous, feeling, upset. And so, there's a way to manage funds in retirement and a way to manage your assets in a way that you don't need to feel that way. And that, really starts with the whole philosophy that most people approach retirement and they don't make any allocation changes from what they had all those years they were accumulating. And they kind of approach retirement with this one big portfolio. And maybe you've got, a good allocation as far as maybe it's a 60-40,
right.
60 being equities, 40s being more, a safer bond type fixed income portfolio. It's still all one portfolio, and you're drawing off of that for income. And again, if you start to see major corrections in the markets, and that portfolio is losing value rapidly while you're taking those withdrawals, then you start to maybe make poor decisions when you start to reallocate that portfolio. And in order to avoid that, I would just say we'll share our general philosophy on this, but don't go into retirement that way. Go into retirement with at least 3 different portfolios, and have those 3 different portfolios address different time frames of retirement of when you're actually going to need and use that money. And it's really critical that first 5 years of retirement, the portfolio that you're going to use to fund the first 5 years should be very conservatively allocated. It should be in very conservative investments that aren't going to move a lot with the markets at all. and are going to give you a sense of stability of income in those first 5 years. Because what that's going to do is it's going to change your mindset, and psychologically it's going to play a major role in how you feel about your retirement. And if you have money that's not moving around a lot in those first 5 years, you don't feel necessarily the need to make big changes should the market start to correct, in that the other money that you have can be, more moderately or aggressively allocated, and if you don't need it for 5 years, you don't need to make huge adjustments. And man, I'll tell you, that just changes your whole thought process and psychologically makes you much calmer and less anxious when those things are going on and there is a lot of volatility. To avoid that kind of feeling that you get, think about allocating across 3 different portfolios. The first being the one we just mentioned, for the money you're going to need for the first 5 years of retirement. Make that super conservative. It still needs to earn, the best return it possibly can without taking a lot of risk.
Yep.
That can be CDs, it can be money markets, it can be treasuries, it can be bonds, it can be, a lot of things, but make it a stable source of income for the first 5 years. And then you're able to free your mind and to not feel the anxiety and really be pacing a hole in front of the TV, watching the markets as things get volatile as they are right now. And, take that psychological part of it off the table for yourself. You'll do yourself a big favor.
You will. And you'll prevent yourself from, the most fundamental mistake is, without that allocation structure, what'll happen is your accounts will be down, you'll need the income in retirement, of course, and you'll start selling out of the positions that you're relying on doing well. When we've got the first 5 years covered, we know where that money's going to come from. We can leave ourselves that longer time horizon stuff like aggressive stocks and that sort of thing to grow. But if you're in retirement and you don't have that plan and the account starts losing money and your stocks that you expect to do well over a long time horizon are down, you start selling out of those, then you're taking yourself out of the position to get the high returns, which we need on some of the portfolio. Not everything, but some of it. And this, understanding the mix of these things, these time horizons, is the backbone of retirement income planning.
Yeah. We're going to talk a lot more about this, guys. We will be right back. If you want more information, go to clearpathretirement.com, and we'll be back in just a few seconds.